Welcome back. You're watching the India Development Debate, and we want to talk a bit about what is happening with fixed deposit investors. Over the course of the last 5 to 6 years, yields on fixed deposits have almost halved for depositors. Now, a large number of these fixed depositors or fixed income savers are senior citizens, are pensioners, are retirees, or are people who are depending on these incomes for their livelihood. So even as we often celebrate the lowering of interest rates because it helps businesses, it helps banks with their credit growth, let's spare a thought for savers and investors as well. So my colleague Mubina has put together this very special story on what you can do right now if you want to save some money, you don't have the kind of risk appetite that equity needs, and you're looking for options.
When it comes to investing, traditionally, Indians have liked to play it safe. After gold, their usual port of call is fixed deposits, a certificate with the interest written in black and white. But today, fixed deposit rates are so low that they barely even cover inflation. A one-year FD with SBI yields just 5.1%, and that too is a tad higher than the average 4.5% that most banks are offering. IDFC First and Yes Bank may be the few outliers with 5.75 and 6.75% respectively.
They would go to a corporate, which is a AAA rated corporate, which has been in existence for the last 20, 30 years in the country, and they would go and invest with those fixed deposits. But unfortunately, all said and done, everything's around the 6 to 7% kind of a mark, and I do not even see going forward anything will improve for their lot.
Liquid funds, which are often used by savvy investors to park their money for a few days instead of a savings account, too has given dismal returns. So for those with an allegiance to fixed income investments, what are their options?
It's time to look at a lot of other options. Go to mutual funds. They're doing a fantastic job. Look at banking and PSU funds. Look at short-term funds. Look at gilt funds. I mean, gilt funds, yes, there is a little bit of volatility there. One needs to, proceed by full understanding and knowledge. But there is zero default risk.
The returns from these funds have indeed been very attractive. These options are of the fixed income type, but not guaranteed. They depend on market conditions. For those who want their interest written on pen and paper, corporate FDs are a good option too. Karthik Jhaveri advises looking at AAA or AA plus rated companies and be okay with a 9 to 10% return.
A lot of these debt funds have even done double-digit returns in the past 365 days. But it's not guaranteed, right? It's not confirmed. But it's time to adapt to a new way of portfolio management, a new way. You need to have a new type of a debt portfolio. So one has to expand horizon beyond fixed deposits, and there is no option to move beyond fixed deposits and go to better instruments and go to a whole variety of instruments. Have 6 or 7. Break up your 100 rupees between these 6, 7 different type of instruments.
Fixed deposits may provide you a guarantee and comfort for your capital and interest. But if you want to generate that alpha, you must look at the entire umbrella of fixed investment instruments out there.
All right, let's go across to our experts. Lakshmi Iyer joining me on the show today, as is Harshvardhan, Roongta. Welcome to both of you. Lakshmi, let me come to you first. What can investors do? Not everyone has the appetite for equity, and we're talking specifically about your vulnerable sections of society, sometimes your senior citizens, your retirees, your pensioners, those who are really depending on this income to run their household, for example. What can they do right now?
Yeah, hi, good evening. Yes, it is a very pertinent question. And this question assumes significance at a time when the interest rate cycle is actually on its journey southward. And in this particular instance, it has got further accentuated because of the medical crisis. The answer is not a very straightforward or a straight-jacketed cut, copy, paste solution to all sets of investors. It is clearly a function of how much of risk appetite an investor can fathom, whether he or she is a senior citizen or otherwise. And of course, most importantly, for what tenor are we talking about these investments? There is a very strong case that can be made to diversify investments from traditional mode of investments, which obviously offer highest degree of assurance of rate of interest and safety in terms of capital, into slightly more market-linked product categories, including corporate bonds or mutual fund fixed income units. I think it's a combination of each of these in the right proportion, which is one of the potent solutions to get out of the situation.
Mr. Roongta, I know you advise people on things like this. Is it really easy right now to tell people that go in for mutual funds, go in for things with a little bit more risk, but at least you will beat inflation? Are people receptive to that advice?
Well, Tamanna, if you're looking at an investor's portfolio, a person who is dependent, as you mentioned, there are senior citizens, there are people who are retired who are dependent on this income to run their households. Now, you have to get a respectable return on your investment. Only then would you be able to actually get meaningful money in your hand to meet your expenses. So the idea is very simple. Now, you have to accept the fact that interest rates are on a downward movement, and they're no way going to come up again in the near future, at least. So how do you create a portfolio? So answering your question, there is no alternative. Now, if I were to tell you that if you're constructing a fixed income portfolio, there will be some amount of money which will go into fixed deposits. Without the doubt that they are low on returns, you still have to have some money there. There will be some portion of your money which you will have to get accustomed to and accept the fact that I need to go in for market-linked investments, which are through those mutual funds. You can go to the debt funds. You can go in different categories of the debt funds that are available. Now, what is important to understand here, while you're talking about interest rates coming down, there is this market-linked product which actually gives you capital gains, basically gives you additional returns if the interest rates come down. So you have to understand it and accept it. The degree, the percentage of investments that you do into these products could be less to begin with. You could start with, say, probably a 10 or 20% of your total corpus. The moment you start getting comfortable with it, you will have to start increasing your allocations to these market-linked products. That's the only solution wherein you will be able to capture and actually benefit from our interest rates falling down. So as far as investors are concerned, I guess slowly and gradually they're understanding this fact. And, gold has been one of a distraction in the last 1 year, where people have suddenly believed that gold is an alternative to fixed deposits. Well, that's not the case. It's been an exceptional year for gold, where they've given about 30 to 40% returns, but that's not going to continue forever. So I think all fixed instruments are going to be such that people will have to start looking at them very actively and get accustomed to it slowly. And
I was looking at this data from the Reserve Bank of India, and actually our team helped put it together. 52.6% of household financial assets go to commercial bank deposits. That's still how India saves. Let's go beyond, a very small minority who uses sophisticated instruments. Lakshmi, this question's for you. Most of India saves in bank deposits. Is it time to get over that mindset, because they're not even beating inflation and it's unlikely that this situation will change anytime soon?
See, Tamanna, the situation is such that the straitjacketed solution or remedy to just switch from bank fixed deposits to any other source of revenue or interest generating avenue is not going to work out, because when the interest rates are coming down, even the market linked investments tend to be delivering lower returns. But yes, the difference is that they are market linked, so that is the saving grace. However, if we are talking about inflation specifically, no amount of having just fixed income, including fixed deposits, bank deposits, etc., as part of your portfolio, can really achieve that feat of being able to arguably beat inflation sustainably over the years. For that, there is no option but to have a combination of fixed income, maybe sparing equities and sparingly gold as part of the portfolio, and that cycle will clearly act in your favor over time. So I think some small portions of that, yes, there can be answers. If I give you an example today, a 2 to 3 year PSU bond is yielding just about 5% or maybe even lower than that. And this is not that India is an exception. World over, we are seeing such low interest rates because central bankers are easing
absolutely
interest rates.
absolutely it's time for our savers to also move with the times. I've run out of time, Lakshmi, so I will have to end it there, but I want to thank all of you for joining us on the show this evening. Stay with ET Now.